Guys, I created a shortcut that would allow me to look at a company from a very high level very quickly to see what kind of questions and what my next steps are for analyzing the business. And I called that my 8-pillar process. Here are the 8 pillars and what they each mean. I'm going to pull up an example with Microsoft. So we pull up Microsoft, we pull up the 8 pillars in the 8 pillars tab. First one, 5-year PE ratio less than 22.5. What I did here was take the current market cap of the company, 3.22, and I divide it by the total earnings of the last 5 years. You can get that by going to the net income, adding up all 5 years of net income, and if it's less than 22.5, it's a check. If it's greater than, it's an X. 5-year return on invested capital. Basically, the invested capital is how much cash flow the business is making based on the money invested in the business in terms of equity and debt. Take the last 5 years of the free cash flow divided by the current equity and debt in the last quarter. That's our ROIC for the last 5 years. Shares outstanding, very simple. How are the shares outstanding this last quarter versus 5 years ago quarter? That's simple. If it's less than, it's a check. If it's greater than, it's an X. Cash flow growth in the last 5 years. Very simple. Has there been more cash flow this last 12 months versus 5 years ago? If the answer is yes, check mark. 5-year net income growth. Again, is there net income growth in the last 12 months versus 5 years ago? Answer is yes, check mark. Revenue growth. Is there more revenue in the last 12 months versus 5 years ago? Very simple. Now, long-term liabilities divided by 5-year free cash flow divided by 5. So I take the total long-term liabilities on the balance sheet. I take the average 5-year free cash flow. I divide the long-term liabilities by the 5-year free cash flow. If it's less than 5, it's a check. If it's more than 5, it's an X. For Microsoft, it's around 2. So it basically says 2 out of the last 5 years average free cash flow could pay off all the long-term liabilities. And the final pillar, 5-year price of free cash flow less than 22.5. Take the current market cap. This is similar to the PE ratio. Take the current market cap divided by the total of the last 5 years free cash flow. Is that less than 22.5? If it is, it's a check. If it's more, then it's an X. But these are the things that made sense to me. I wanted to see companies that had a good ROIC. Why? It means they have a moat, as the ROIC is higher, and they can invest the money at a higher rate of return. So it means they can go compound their profit even faster than others, okay? Shares outstanding. Now, this is a tricky one. I want to see shares down, but the most important part is the story we're telling ourselves. Combining this with these two is always a little bit of reservation. I don't want them buying back expensive shares. That's what I mean when I tell people the 8 pillars are telling a story. I'm combining the pillars and I'm coming up with questions. Okay, so they're buying back shares, but their stock's currently expensive. Have they been buying back shares recently at an elevated valuation? Were they only buying back shares when things are cheap? These are the questions to ask. And this goes very quickly. I'm spending the next 10 minutes talking about these, but you'll get to the point where you're looking at them, blink of an eye and saying, boom. And one of the most annoying things in the world to me on Twitter is when I see people who are so thirsty for attention. They say, I spent the last 300 hours researching this and this is what I found. Well, then you're inefficient. That's stupid. If you truly know something well, you can do it very quickly. Guys, I want to stress, anybody who brags about how much research they've done, let me put it this way. I've never met anybody who brags about how much work they've done and I've been impressed with them. To me, it's just an excuse in the future for, oops, I made a mistake, but look all the research I did. It's not coincidental that Charlie Munger and Warren Buffett, some of the best investors of all time, say, if we can't do it very quickly in the back of a napkin, we're not doing it. Yet you have everybody else has all these Excel sheets and things open and blah, blah, blah. Guys, you'll see shortly, our stock analyzer tool is a very simple discounted cash flow model. That's it. Because the point is to keep it as simple as possible. As you go through these things, you'll understand very quickly the things that you gravitate towards. But it's super, super important to remember that simple is better in investing. All the news is going to follow the stock price when it's going up to say how awesome it is. All the news is going to follow it on the way down and says how bad it is. What's important for you is to think long-term and say, I don't care about these short-term decisions. And I did my quick research and I realized this is a good company at a great price. I use my 8 pillars to pre-screen. That's how I use it. If I see a lot of X's here, Unless there's a reason for that, I go, okay, move on, find the next one. Because guys, there's 10,000 plus companies out there for you to buy. Go weed them out to the 20 or 30 that you actually want to spend time researching. Don't go sit there and research every single one of them. If you do that, then you will waste a lot of time and you'll get nothing done. All right, so a few things also. Cash flow growth and net income growth. Are they growing? Do they have more cash flow and net income today than they did 5 years ago? Revenue. Are they growing? Do they have more revenue they did today than 5 years ago? Remember, I want to buy companies that have growth. Doesn't matter to me how much growth it is. This is a very important factor. But remember, if it's like Southwest and Disney during the COVID, this is going to be X's right here, X right here, X right here. It's all part of a story and you understanding that story. Next, and probably one of the more important ones, do they have reasonable debt? This is one of the few that if there's a lot of debt on there, I immediately run away from it. Guys, debt is awesome. It's a great way to grow, but a well-managed and well-growing business doesn't need debt to do better. It's just an excuse for whatever reason. Listen, I'm not going to say who it is, but if somebody I know runs a $5 billion company and he loves taking on debt. Why? Because he loves paying himself a dividend. And that to me is the most selfish thing you can do as a CEO. And these two things right here can lay a lot out there. How does the management think? How is management going to run their company? To me, I have 8 or 9 businesses upstairs. The only ones that have debt are the real estate ones. You can run a good business without a lot of debt or any debt at all. Now, every story is going to be different. Different X's, different checks. This one is, I don't even remember what company I picked. Microsoft. This one tells me that this is a well-run company, low debt, not buying back a lot of shares, which is okay at these high valuations. So it may just be an expensive company. But remember, if they have a high return on invested capital, if they have a lot of growth potential, these could be X's for no reason other than they're just above 22.5. It could still be a good investment. That's why you don't make decisions just based on these 8 pillars. You make a decision based on screening out from here and deciding, what am I going to do with this information? What do I need to look at next? This is exactly why we have all these tools in our community. This is exactly why we have the community. Now, you may have noticed if you've looked at our website, everythingmoney.com, we only have a limited number of daily spots for the Everything Money community and software, including the 8 pillars. And the reason for that is the software as it exists today currently includes everything for retirement, stocks, and real estate. We now have 4 YouTube channels and probably growing even further from there. So behind the scenes, it's very important that we make some big changes as we continue to expand our offerings. Now, these offers are going to be separated. All of these are going to be separated very soon. And the current offer of everything is going away. Now, you may remember if you've been watching us from the beginning, this software started as literally me on an Excel sheet and people asking, hey, how do I get that Excel sheet? How do I get that software? And I finally said, let's just make it for everybody. So I use this software every single day to make better decisions and for my team to make better decisions in all aspects of my money. But the channel's growing, the community's growing, and they've grown immensely since we started. I remember the first day we offered the software, we had 2,200 YouTube subscribers. We now have 270,000 YouTube subscribers. So it's becoming less about me and more about how I can better serve you and the community members. But the good news is these changes haven't been made. So if you join today, you'll be grandfathered in for life with all these tools, all this data, and you'll be in your price tier forever. You'll get all of this and your price tier forever. It's the best deal we've ever offered. So if you're serious about making better financial decisions, probably increasing your returns, but more importantly, sleeping better at night, click on the link in the description below and you'll get everything we have here. And I'm very confident it'll be a great decision you're making. Now, once I find a company here that I've sat there and said, okay, even before I do research, I like all of this. Before you go any further, what do? I go to a stock analyzer tool. Now, what is stock analyzer tool? Stock Analyzer is an incredibly powerful tool that helps investors evaluate and analyze stocks using key financial metrics, and I use it daily. Its purpose is to simplify the investment process by allowing users to make assumptions about a company's future performance, such as revenue growth, profit margins, free cash flow, and price-to-earnings ratios. It analyzes data based on investors' expectations and desired returns. The key thing here is that it saves you so much time. With the right assumptions, you can know within seconds if a stock is worth doing more research on, if you need to wait until the price falls further, or if it belongs in the too hard pile. Am I going to pass on things that end up being great investments? For sure, because a lot of companies in their early stages that can compound have a great story. And it might feel like you're overpaying based on the numbers. But it's about if it's so egregious. Let's say Microsoft was 405 and it should be selling for 50 is my value. Why go further? Why go any further? Now, if you came with a value of 350, I would sit there and say, hang on a second, this is pretty close. Maybe there's things that put you over the edge saying, I think I'm going to buy this. Or maybe you find things out saying, you know what, 350 is my price. I'm just going to be patient there. The next step to your analysis is use a stock analyzer tool. Sit here. How many years do you want to analyze it for? You can do 1 to 20 years. Sit there and put that in there. Put your revenue growth assumptions. I love when people say value investors don't care about growth, when my very first input is growth. Put your profit margin, your free cash flow, your multiples, your desired return. If the numbers at the bottom, even if they're all red, even if they come out all red, but they're close, do more digging. Get yourself ready. Let's pull up the last time I did Microsoft. Last time I did Microsoft, here are the numbers I got. We're at 405, and my fair value is 350 to 325. Guys, it's getting pretty close. So what does that mean? Hey, be ready to pull the trigger, because guess what? 2 or 3 years ago, my fair value of Microsoft was 150 to 180. It's gone up significantly since then. So it's about understanding where the company is right now, relating the story with the numbers. But you've got to be able to do that. Once you put it in stock analyzer tool and see how close you are, then if it's close, go do more due diligence, go into the community, have the conversation, see what others have said about it. Because we have thousands of people in here, and I guarantee you're not looking at the stock that nobody else has gone through. So guys, if you want to see the 18 stocks that I own, watch our next video. Thank you for your time.